Okay, so let's get right into it. We're going to take a look at Uni-Asia Group's performance for the first half of 2025. And honestly, it is quite a story. It's all about how they navigated some seriously tough conditions to get back into profit. But this isn't just a simple recovery story. It's a really complex picture with strategic moves, big operational challenges, and two very different market realities. So let's break down exactly how they managed to turn the ship around and maybe figure out if this comeback is built to last.
And this right here is the headline that just makes you stop and look. In the first half of 2024, the company was down nearly $12 million. I mean, that's a significant loss. But then, you fast forward just 1 year, and they've completely flipped the script. Now look, $600,000 in profit might not sound like a huge number, but that's not the point. The point is the direction. That swing of almost $13 million from loss to profit, that's the real story here. It tells you something big has changed.
And, the company isn't trying to sugarcoat things. This quote comes directly from them, and it frames the whole period as a massive stress test. They were dealing with everything from a major collision at sea to a cybersecurity incident, all while trying to execute this huge business transformation. So this wasn't just your average business-as-usual 6 months. This was really about proving they had the strength to weather a storm.
Which, of course, brings us to the big question. How on earth did they pull this off? A $13 million swing like that doesn't just happen by magic. Was it because the market suddenly started booming? Did their revenue just shoot through the roof? Or was it something else entirely? We're about to peel back the layers and see what was really driving this turnaround.
And here it is. This is the answer. The big comeback wasn't really driven by a boom in their day-to-day operations. No, the single biggest factor was this huge swing in investment returns. See, last year, they had to report a massive non-cash loss on some property investments in Hong Kong. This year, that loss didn't happen again. In fact, they actually got to record a valuation gain on their ship investments. So, that massive swing you see on the screen, it's mostly an accounting story, and it's the foundation for their return to profit.
So let's switch gears and talk about their core shipping business. Because while the company as a whole got back in the black, their shipping division, their bread and butter, was actually facing some pretty serious headwinds. And this is where the story gets really fascinating, because it shows just what they were juggling behind that headline profit number. And here's the tough part of the story. Their main source of revenue, the money they actually make from leasing out their ships, took a 25% nosedive. It fell from almost $16 million down to just under $12 million. That is a huge drop, and it tells us that even though the company made a profit overall, its main operational engine was kind of sputtering. So what happened? Well, it wasn't just one thing. It was basically a perfect storm of 3 separate issues hitting at once. First, they were selling off some of their older, smaller ships as part of a longer-term strategy, so their fleet was just smaller for a while. Second, a crazy amount of their fleet's time was spent off-hire. That's time when the ships are in for repairs and not earning any money. That jumped to 12% of all their possible charter days. And third, the one thing every shipping company fears, a major collision. This timeline really puts that collision into perspective. On April 25th, one of their ships, the MV Glengyle, collided with another vessel. Just 5 days later, they had to declare something called a general average, which is a big deal in maritime law. You only use it for really serious accidents. It took over 3 weeks just to get the 2 ships apart, and the Glengyle wasn't even towed into port until early July. So this key money-making asset has been out of action since the end of April, which is a massive hit to revenue. So, what's their game plan to deal with all this? Well, it's actually a really clear 3-step strategy to renew their fleet. Step 1, they're getting rid of their older, smaller, less efficient ships. Step 2, they're replacing them with younger, bigger, and more valuable vessels. And step 3 is the really clever part. They're not just using their own cash, they're bringing in partners to co-invest, which means they can expand faster with less of their own money, and it helps grow their asset management business at the same time. Pretty smart.
Okay, now let's jump over to their property business. And man, if you want to talk about a contrast, this is it. It is truly a tale of 2 completely different markets.
I mean, look at this. It's night and day. On the one hand, you've got Hong Kong. The market there is so tough that the company has valued its investments there at 0. They've basically written them off, saying any chance of getting their money back is remote. But then you look at Japan, and it's the exact opposite story. The market is strong, demand is resilient, and foreign investors are really interested. So Japan has become the solid foundation of their property strategy. And what I love about this chart is that it shows you just how smart their strategy in Japan is. They're not just putting all their eggs in one basket.
Sure, they have residential properties, but their biggest slice of the pie is actually in public infrastructure projects. And look at that second biggest piece, healthcare and group homes for people with disabilities. They're diversifying into these stable, long-term, and socially important projects, which is a world away from the volatile Hong Kong market.
All right, so with all these things happening, new ships coming in, old ships going out, property deals in Japan, what does all this mean for the company's actual financial health? For that, we've got to pop the hood and look at the balance sheet. It gives us a great snapshot of what they own versus what they owe.
Okay, let's break this down. A couple of things really jump out. First, their total assets are way up, from about $166 million to $184 million. That makes sense. It's the new ships and properties. But, and this is the big question, how did they pay for it? Well, look at total liabilities. That's up by over $12 million, which tells us they took on more debt. And you can see the result of that down at the bottom. Their cash pile has shrunk by about $7 million. So the story here is growth, but it's growth funded by borrowing.
Now, this chart puts that borrowing into perspective. Their debt-to-equity ratio, which is just a fancy way of measuring financial risk, has ticked up a bit. You can see it went from 0.36 to 0.44. That's a direct result of taking on those new loans. But here's the key. A ratio of 0.44 is still very, very manageable. They're using debt to grow, which is normal, but they're not getting in over their heads. It's well under control.
Okay, so that's where they've been. They've weathered the storm, they've started to transform the business. But what about where they're going? What's the outlook for their key markets? Well, surprise, surprise, it's another story of contrasts.
For their shipping business, it's a real mixed bag. A classic good news, bad news situation. The good news is that charter rates, the price they can lease their ships for, should stay pretty strong. Part of that is because new environmental rules are taking some ships out of the market. The bad news? Geopolitical tension and supply chain chaos mean the market is going to stay volatile. Meanwhile, over in Japan, the property market still looks really solid. Demand is high, interest rates are low. The main challenge there is actually rising construction costs and more competition for good land, which could start to squeeze their profits a bit.
But despite all the uncertainty, despite the ship collision and the costs of transforming their fleet, look at this. The company's board still declared a dividend of 1 Singapore cent per share. And that right there is a really powerful signal. By keeping the dividend the same as last year, management is basically telling the market, hey, we know it's been a bumpy ride, but we are confident in our financial health and our ability to generate cash.
So this is the big question we're left with, isn't it? They've managed to get back into the black, which is great, but we've seen that a big chunk of that was due to an accounting reversal, not a huge surge in their core business. Their strategy to modernize the fleet and dig deeper into the stable Japanese property market seems really smart, but the world they operate in is still full of risk. So the question is this a truly sustainable turnaround that's going to lead to long-term growth, or was this just a temporary port in a much bigger storm? I guess only time will tell.